In this video, we will share our house view on the FX markets in first half 2024, specifically our views on the dollar, Asian currencies, and some of the risks to keep a lookout for. In second half of 2023, in particular from July to October, dollar has seen considerable strength. Fears of higher for longer alongside US growth outperformance were the main drivers that underpin dollar strength. But the dollar narrative is starting to shift, led by softer US data. This inflation trend in US is proving more entrenched, while the tightness in the labor market is gradually easing. And more recently, Fed's rhetoric is becoming less hawkish. This allows for the Fed to adopt a wait-and-see approach or possibly to pivot. FOMC decision in December reinforced the message that Fed is done tightening for current cycle and is paving way for rate cuts. Markets have turned more dovish in pricing about 150 basis points cut for 2024 and for the first cut to come in March. Overall, the shift in dollar is a setback to the higher for longer market narrative. We remain biased to adopt a sell-on rally for dollar as Fed is done with tightening for current cycle. Given Fed's pivot, the next leg of dollar's decline will depend on two factors. One, how much more markets expect the Fed to cut, and this is highly dependent on US data. And two, how global growth pans out. If global growth can trudge along well alongside a more sustained exports recovery momentum seen in Asia so far, then the counter-cyclical dollar could further stay under pressure in the coming months ahead. We do see room for Asian currencies to recover on a few fronts. One, yield differentials to narrow in favor of Asian currencies. Two, exports rebound in the region. And three, eventual return of portfolio flows. If we recall, widening yield rate differentials between US and Asia was a key driver of Asian currency FX volatility, as well as its weakness. But as Fed embarks on the rate cut cycle in 2024, the higher for longer narrative becomes a lesser risk. US-Asia rate differentials can narrow, and this is supportive of Asian FX recovery. Some of the Asian currencies that can ride on these easing US rates are the Korean won, the Japanese yen, Indonesia rupiah, and the Malaysia ringgit. There are signs that the export slump for some countries in Asia may have moderated. Exports growth for Taiwan, Korea, Japan, Vietnam, Singapore, and China have turned positive for the first time in a year, while the exports of Indonesia and Malaysia are becoming less negative. More sustained and broader recovery is needed for this exports recovery story to gather traction. And when that happens, some of these currencies that are highly sensitive to exports, such as Korean won, Taiwan dollar, Singapore dollar, and yen, can potentially benefit. To add, we see greater room for recovery for Asian FX that are both tech and trade linked, and that includes the Korean won, the Taiwan dollar, and the Japanese yen. Portfolio inflows into the AXJ region as a whole could potentially pick up in coming months as US rates ease and if growth narrative in the region still holds up. Eventual return of portfolio flows can be another driver sustaining the momentum in Asian FX recovery. Finally, on risk, geopolitical events are of top concerns. The armed conflict in Israel-Hamas, Russia-Ukraine are still ongoing. Further escalation can potentially have implications for oil prices, supply chain disruptions, and that can have repercussions on growth, inflation, and the dollar dynamics. Next is election risk. The year of 2024 is a record year for elections globally. More than 2 billion voters in 50 countries will head to the polls, including the US, Taiwan, Indonesia, India, Europe, Mexico, and more. Major upsets can have implications on growth and policies, and these can have implications on currencies. Other risks that we also keep in mind include China's recovery momentum, if it is sustained, or will growth sputters, as that would result in swings in the RMB. Finally, on Fed policy, if the higher for longer narrative proves more lasting, or if the Fed cuts more drastically. All of this will have impact on the currency markets. Despite the risk, we see opportunities for first half of 2024. We see room for Asian FX, in particular Korean won, Taiwan dollar, to recover more on the exports and tech story. We also favor a long goal exposure as US real rates should continue to ease as Fed embarks on rate cut cycle and also serves well as a geopolitical hedge. We also favor long in Aussie and Kiwi, riding on the China stabilization story, while respective RBA and RBNZ are likely the last few DM central banks to cut rates. We also see room for yen to gain as US rates ease and BOJ is likely to step away from its YCC and NIRP before the mid of 2024.